then $50,000 is probably not going to be enough. So the parents say, well, we don't want to pay for a bunch of insurance right now. We don't want to have a huge amount of insurance on this child's life. So what they might do at this young age, they might add the guaranteed insurability benefit, or guaranteed insurability option, or guaranteed insurability rider, or future insurability option, or future insurability rider, whatever term your particular insurance company happens to attach to it. So we add this guaranteed insurability benefit. It will result in a commensurate increase in your premiums. Maybe an extra 25% will be added to your premiums for adding on the guaranteed insurability benefit. But the nice thing is that now, starting usually at the child's 18th birthday and usually every 3 years thereafter, some insurance companies have different variations, you'll be able to add an amount of insurance. It wouldn't be uncommon to see either the face amount or maybe half of the face amount able to be added. Let's use the face amount. So at age 18, this child says, I don't really need any more insurance. I'm 18, I don't have any meaningful financial obligations. So we look at the guaranteed insurability benefit. We say, yes, we have the opportunity to add more insurance, but we're not going to. So the GIB stays in place, and maybe by age 21, the child still will have the original $50,000 of insurance in place, but probably at age 21 they're not going to see a real change in their need for insurance unless they've gotten married early or they have some debts. But let's assume that the child still doesn't need any more insurance. But let's say between age 21 and 24, they go and they buy their first condo. They go and they spend some money, they end up in a condo, and now they say, you know what? I'm going to need some insurance to cover off the mortgage that I have on that condo. So they add, at this point, at age 24, $50,000 of coverage. They now have $100,000 of coverage. Now here's the really great thing about the guaranteed insurability benefits, that it doesn't matter what decisions this child has made between 3 and 24. We don't care if they're a smoker, in most cases. We don't care if they are doing dangerous jobs, if they're traveling to dangerous parts of the world, if they've had some health condition. None of that matters. What's going to happen, we just say, look, you can acquire that extra $50,000 of insurance as if you were a healthy 24-year-old. Basically what we're doing is we're taking the underwriting information from back at age 3 and we're transposing that onto this 24-year-old. So yes, you're going to have the attained age of 24, you're going to be buying insurance as a 24-year-old, but you're going to be buying insurance as a 24-year-old who was as healthy and had the same lifestyle considerations as when we originally acquired this insurance when this child was 3. So your premiums will increase, but they'll increase at a fairly manageable level. This $50,000 of insurance comes for the healthiest possible consideration here. Most likely when the kid was 3, there was not much going on. So now, at age 27, now we started to have some financial obligations here. Maybe we add another $50,000 of coverage. We now have $150,000 of coverage. And maybe we routinely add some coverage now. You're going to find that typically it's going to be sometime in the mid-40s when you're going to have your last possible option to exercise. Maybe at age 45. That might be the last point at which you can exercise a GIB. GIB riders never go into the 50s. Some of them will go into the late 40s. So the GIB for the 45-year-old, maybe by this point we've got $300,000 of coverage. We add another $50,000 of coverage, again without any kind of underwriting, based on attained age of 45, but the insurability back at age 3. And we have $350,000 of coverage now. Again, it doesn't matter what kind of lifestyle decisions or medical situations arose in this child's life over that 42 years. The child now has $350,000 of life insurance, and even when the GIB runs out, so let's say that is the end of our GIB, that insurance still stays with them for as long as the term of the insurance happens to go. If it's permanent insurance, which as I said it most likely is, fantastic. We've got $350,000 of permanent insurance. Now, some of the limitations on GIB, I do think this is a very effective rider done correctly, but some of the limitations on GIB is that it's not cheap. I said over here that it might increase your premiums by 25%, give or take. If you have a client who's age 27 who's looking to acquire insurance, it probably doesn't make a lot of sense to use the GIB rider. You're probably better off just to sell that person the amount of insurance that they need, because they're not going to have that many options left to exercise. They're only going to have 4 or 5 opportunities left to exercise a GIB option. And if they happen to miss one, normally what happens, you hit the birthday, so let's say the 27th birthday, you hit that birthday, you have, say, 90 days after that period to exercise. If you don't, then your option is lost. You can't generally catch them up later on. And because of that, selling it to somebody who's later on in life who may not exercise the options, who already has a need for insurance, just sell them what they need here. But at a younger age, 21 and earlier, the cost is generally worth it, and it is more realistic that you're going to have more options actually exercised. Okay, so that's guaranteed insurability benefit. It's a very frequently used rider. As I mentioned earlier, it is almost certain that you will be tested on this rider.